things are super, super tough on the JSE. And if you look at percentage of the JSE in rand terms, that's in a bear market, we're at levels we last saw in the midst of the GFC. So it's 80% in rand terms. The average stock on the market is down heavily, and it's down heavily in a world of really, really low confidence. We're seeing 40-year lows on business confidence currently. We're all attending the same kind of dinner parties. We're all reading the same headlines, and I think we're all aware of just how gloomy things in South Africa look at the moment. And we don't disagree with the fact that South Africa has structural challenges. We're certainly not standing up in front of you today trying to paint a rosy picture and saying everything's going to be fine tomorrow. But what we do want to introduce into the conversation is two aspects. The first is we don't think a very balanced discussion is taking place with respect to South Africa at the moment. We think it's a little bit one-sided. And we also think you need to acknowledge where starting prices are, because we think that has a bearing on returns. So in terms of the balance of the discussion, we all know what's getting airtime at the moment, and it's the column on the left. But what we believe is receiving less attention are the factors on the right, which, to be honest, are some of the factors, or are the factors that are actually most relevant for asset prices in this country. What is important to asset prices in this country is the strength of our institutions, and in particular, the success that the South African Reserve Bank has had, and we expect to continue to have, in anchoring inflation to low levels. The reason that bond yields blew out in a place like Brazil and are currently blowing out in a place like Turkey is because you've lost control of inflation. But the thing that we do find most interesting is what is reflected in asset prices. And it's our view that asset prices are, in many, many areas, only reflecting the left column and aren't taking a balanced view. What that means is that if you can predict that point where pessimism is at its most extreme, it's actually a very good time to be investing. Now, we're not in the world of predicting when South Africans are going to get most pessimistic about their country. But again, I remind you of a point in time. 9th of March 2009 was the day that global stock markets bottomed. And you can go back, you can read the headlines, you can go back and look what was happening in the economy. There was nothing different about that day. But on that day, the financial markets decided that prices had overshot too low. It was only months and years later that people actually saw the green shoots and things starting to improve in the economy. And this concept of extreme pessimism or excessive pessimism, when people say structural issues cannot be overcome, and that overshoot the results, there's some very interesting recent case studies of what that does to asset prices. And we'll reference Greece in 2011, 2012. For us, it was not obvious that there was a quick fix to some of the challenges that Greece was facing. Brazil in 2015 had significant issues. The economy was tanking, inflation was spiraling, they had significant corruption issues, etc., etc. Roll forward a few years, what happened? If you had managed to predict that point of maximum pessimism as far as Greece was concerned, you've made almost 10 times your money on Greek bonds subsequently. And if you pick that point of maximum pessimism as far as the Brazilian stock market is concerned, you doubled your money in dollar terms over the subsequent year. As I said, we're not claiming to have any ability to predict that point, but what we are seeing is clear evidence of very excessive pessimism being baked into share prices. And what that does is it gives rise to the opportunity to buy good businesses at fantastic prices. And what I show you here is I show you 6 of the stocks that would be in the top 10 of all of our local funds. They're companies that we think we can buy at a very wide margin of safety. Discovery is an example of a company where growth is baked into PSG's assessment of what the company is worth. We're prepared to invest in companies that we're bullish on the growth prospects, and here we're primarily referencing the international growth prospects. at a time when that's not incorporated into the share price. We also see very good opportunity in large cap South African financials, the old mutuals and Nedbanks of the world. All of the stocks, with the exception of Discovery, will be trading on free cash flow yields of in excess of 10%, which is an excellent starting point for people that care about valuations. And then we're particularly excited about some of these mid-cap South African names, these industrials that people have just given up on. In this tough economic climate, AECI grew their underlying profit 9%. It trades on 8 times earnings. More than 40% of profit is actually being generated outside of Africa, where they're selling their mining explosives and chemicals into other parts of the world. But it's being basketed with those deeply out of favor South African stocks.